Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing CVS's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 105 billion market cap. They're trading at $81 a share, and they have 1.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a lot of free cash flow in 2021, almost 16 billion. It has come down since then, 11.3 billion in the trailing 12 months. That's probably why their stock price is declining. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in the trailing 12 months at 8.5 billion, nearly double 2022's number. Look at their revenue. It grows a ton each year, from 270 billion to 290 billion to 320 billion to almost 350 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 151 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company $136 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of 106. They're trading at 81, so they're trading at a 23% discount. It's a pretty strong buy according to the model. In May, they were trading at $68 a share. My stock price was 100. They're up to 81, and it still looks undervalued. Maybe I'll put some money into this stock. There are 12 companies in the same industry as CVS, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent a lot in CapEx, 2.8 billion. The only other company bigger is UNH, 3.3 billion. They are a bit leveraged, debt to equity of 1.1, worse than this list. For every dollar of equity, they have $1.10 of debt. They do pay the highest dividend, 3%. They generate lots of free cash flow, 11 billion. UNH is the biggest at 26 billion. They rank third in market cap at 105 billion. United Healthcare is bigger than the other companies combined. Of all these companies, they have the best price to book, 1.4. The best PE, 12.4. Their price to free cash flow is really good at 9.3. And look at their price to sales, 0.3. They generate a ton of revenue and they're still growing. Their 5-year annual revenue growth rate is 13%. Look at Signat, 34%. Let's look at their most recent 10Q from the third quarter of 2023. We'll start off with their income statement. Revenue for the third quarter, 90 billion, up from 81 billion. They give a nice breakdown. Products, 61 billion. Premiums, that's insurance, 25 billion. Services, 3.5 billion. Here's a different breakdown of their revenue. Of the 90 billion, 56 billion is from pharmacy, 45 billion from health services, 23 billion from pharmacy and consumer wellness. Front store is 5.4 billion. Premiums, 25 billion. Let's take a look at this income statement. They show percentages, which is nice. In the third quarter, their product revenue is up 6%. If you go into CVS, you can buy lots of products. Toilet paper, soft drinks, you can buy chocolates. Premiums is up 17%. The big winner is services, up 53%. That went from 2.3 billion to 3.5 billion. In order to sell the products in their stores, they have to buy the products. The cost of the products sold is 55 billion. That's up 9%. Healthcare costs, 21.5 billion. That's up 24%. So their operating expenses are 9.9 billion, up 3%. Their revenue went up 11%, operating expenses 3%, so their margins are improving. Last year they had an operating loss of 3.9 billion. Now they have an operating gain of 3.7 billion. Their operating income went up almost 200%. They spent 690 million of interest on their debt, so their net income is 2.3 billion. That's for the third quarter of 2023 compared to a net loss of 3.4 billion. Let's take a look at their balance sheet. Current assets of 70 billion. Current liabilities of 80 billion. They usually have a current ratio below 1. That's not such a terrible thing, especially when you're cash flow positive. Because if you sit on a lot of current assets, it's not an efficient way to run a business. You want to use the assets to grow the business. And it's okay to add debt or dilute shareholders every once in a while. Because the goal is to have a positive ROI and ROA, not to sit on tons of cash. Let's look at their current assets, 13 billion of cash, $3 billion of investments, $32 billion of accounts receivables. Here's a breakdown of the accounts receivables. Trade receivables, $10.4 billion. This is how much money their customers owe them for borrowing on credit. $17 billion of vendor receivables. This is how much money their vendors owe them for borrowing on credit. And then premium receivables, $3.3 billion. These are the insurance premiums that are due to CVS from the insurance company. Their biggest asset is goodwill, $91 billion. So they do lots of acquisitions. Total assets, $250 billion, up from $228 billion. Total liabilities, $177 billion, up from $156 billion. Their biggest liability is long-term debt, nearly $60 billion. Here's a breakdown of the long-term debt. It's a really long list. A 4% senior note, $400 million. That was due at the end of 2023. A 4.3% senior note due in 2028, $5 billion. You can see the list goes on and on. Lots and lots of debt. $8 billion due in 2048, 5%. So total debt is $62 billion. $2.1 billion of that debt is due within 12 months. So the long-term part is $60 billion. Let's look at the equity section of their balance sheet. Assets minus liabilities is equity, $74.5 billion. They buy back lots of stock, $34 billion. Retained earnings is how profitable they are, $60 billion. Let's look at the statement of cash flows. This is for the trailing 9 months. Their operating cash flow is $16 billion. They generate lots of cash. Last year was $18 billion. The way you calculate that, you start with your net income of $6.3 billion. You add back the non-cash items on the income statement. The big one is depreciation and amortization, $3.2 billion. That's a non-cash item that brings down your net income, but it doesn't affect cash flow. Then you have to adjust for changes in working capital. They extended $3.9 billion of credit. So that's a cash outflow. When those customers pay for the items, it'll be a cash inflow. They bought $2.5 billion on credit. That's a cash inflow. They bought another $4.7 billion on credit for healthcare costs. And that's how you come up with the $16 billion. This is the indirect method on the statement of cash flows. Well, the only part of the statement of cash flows that may change is the operating section, the first section on the statement of cash flows. You can use the indirect method or the direct method. Most companies use the indirect method, which looks like this. But they use the direct method on their statement of cash flows. This is just a reconciliation part of the direct method. I'll show you their statement of cash flows. This is their statement of cash flows. It has their operating cash flow. Next section is the investing cash flow, and the third section is the financing cash flow. So they use the direct method. You get the same result whether you use direct or indirect. It's just a different layout. So for the direct method, it shows your cash receipts. So how much cash they received from their customers, $260 billion. How much they paid for inventory, $150 billion. They paid $61 billion of insurance benefits. They paid $26 billion to suppliers and employees for payroll and also to buy products from their suppliers. They received $1.2 billion for interest on their investments. They paid $2 billion of interest. That was on their debt. And they paid $2.6 billion of income taxes. So you still come up with $16 billion. I'm so used to looking at the indirect method. If you look on a statement of cash flows from a foreign company, I think they usually use the direct method. But US uses the indirect method. On their financing section, they spent $2.1 billion on PP&E, $16 billion of acquisitions. Lots of acquisitions in 2023. Their big acquisition was Oak Street Health. In order to acquire them, they took on $5 billion of debt, and the rest they used cash. So I think it was about $5 billion cash, $5 billion debt, because the acquisition was around $10 billion. Right here, $9.7 billion. I just did a quick Google search of Oak Street, and this came up. This acquisition cost CVS $10.6 billion. And based on metrics by the company itself, it seems to us that it was a waste of money. The acquisition of Oak Street Health is both disappointing and a warning to us. We now have a company in our portfolio whose capital allocation we consider to be poor and that should not be there. I wish they would say why rather than just bash it. I wish they would give some facts. I'm not saying they're wrong, I just wish they'd give more information. When you go to Wikipedia, it says Oak Street Health is a healthcare network of primary care center for older adults with Medicare. CVS acquired them for $10.6 billion. They were founded in 2012. Congrats to these guys who founded the company. In 12 years, they sold it for $10.6 billion. Oak Street is the only primary care provider endorsed by AARP. That sounds pretty good. Oak Street helps older adults stay healthy by providing preventative care, education, and social activities to support overall health well-being. Let's go back to the statement of cash flows. They added $5 billion of debt. They paid $5 billion of debt. They added $11 billion of long-term debt. They paid $2.7 billion of long-term debt. They bought back $2 billion of their own stock. They paid $2.4 billion in dividends. So in their financing section, they had a cash inflow of $3.7 billion. Here's their stock price since they started trading. They started in the early 80s. The price slowly went up, then slowly went down over the next 15 years. Then from 96 to 2001, it had a really big bull run. Then it dropped down to about $10 a share. That was in 2003. Ran up to over 40 in 2008, came down during the Great Recession to the low 20s. Then it ran way up to its highest point ever to over 110 in 2015. In 2019 and 2020, it did get to about $50 and broke through 110 in February 2022, but it has struggled a lot since then. It did fall to 65. It is up a decent amount since then, but still trading a good amount lower than its all-time highs. Let's take a look at some of their stats on finviz. Their gross profit looks really good. It almost doubled from 2016 to 2022. It pretty much goes up every single year. Operating income also looks really good. It grew about 60% from 2016 to 2022. Net income can be more volatile due to non-cash items and write-downs like impairments. So you can see they had a loss in 2018. That's probably from a large asset impairment. It got pretty high in 2021, almost $8 billion, down to $4 billion in 2022. Probably a large impairment. You see, EBITDA kind of smooths things out. So EBITDA pretty much grows each year, over $20 billion in 2022. So that's how you could definitely know the reason net income was low in some years were non-cash items. A common one is goodwill impairment. Pretty steady margins year to year, 15 to 18%. That's gross margin, gross profit over revenue. Net margin looks a little weird because of those non-cash items. I wonder if they have EBITDA margin on this list. No, I don't think they do. And usually when they do big acquisitions, they have to add a lot of shares. That's why their shares went up a lot from 2017 to 2018. Market cap did grow from 2016 to 2020, but since then it's been coming down. Let's look at the company on Simply Wall Street. Its last price 81, 105 billion market cap, up 3% in the past week, down 11% in the past year. Let's see what they say about the company. CVS provides health services in the U.S. It operates through healthcare benefits, pharmacy services, and retail/LTC segments. LTC is long-term care. The retail part sells merchandise like food and toilet paper. The LTC segment sells prescriptions and health and wellness products. The healthcare benefits segment offers traditional, voluntary, and consumer-directed health insurance products and related services. It serves employer groups, individuals, college students, part-time and hourly workers, health plans, healthcare providers, governmental units, government-sponsored plans, labor groups, and expatriates. The pharmacy services segment offers pharmacy benefit management solutions, including plan design and administration, retail pharmacy network management, mail-order pharmacy, specialty pharmacy and infusion, clinical and disease and medical spend management services. It serves employers, insurance companies, unions, government employee groups, health plans, prescription drug plans, Medicaid managed care plans, plans offered on public health insurance, and private health insurance exchanges. This segment operates retail specialty pharmacy stores and specialty mail-order dispensing, and compounding pharmacies, as well as branches for infusion and enteral nutrition services. The retail LTC segment sells prescription and over-the-counter drugs, consumer health and beauty products, and personal care products. It also provides healthcare services through its Minute Clinic walk-in medical clinics. This segment sells prescription drugs and provides related pharmacy consulting and other ancillary services to care facilities and other care settings. They were formerly known as CVS Caremark and changed its name to CVS Health Corp. That was in 2014. They're headquartered in Woonsocket, Rhode Island. Simply Wall Street is really high on this one. Their price is $243. They say the stock is 67% undervalued. 24 analysts priced this stock at $90. Their revenue is $123 billion in 2013, and it pretty much only goes up every single year, up to almost $350 billion. And the revenue forecast for 2024 is $360 billion, 2025 $380 billion, and then over $400 billion by 2026. Do you think it'll hit those revenue targets? Their debt in 2013 was under $10 billion. It peaked at $74 billion in 2019. It is down a little bit, down to $60 billion. And their equity has crisscrossed their debt. It was higher, then lower. Now it's higher than their debt. And this green line is their cash. They have a small amount of cash on their balance sheet, $16 billion. They're going to pay their next dividend on 2/1. The ex-dividend date is 1/19. X means without dividend. So you have to own the stock on January 18th or before to get that 2/1 dividend. Here's their yield since 2014. It was 1.6%. It got up to 3.7%. It's currently at 3%. The forecast is 3.6% by 2026. And you can see they raise their dividend almost every year or every few years. It's currently at 60 cents a share. The CEO's salary is $1.5 million. Her compensation is $21 million. Karen's tenure as CEO is almost 3 years. In the past year, there's been 2 insider buys and 1 sell. 79% of the company is held by institutions and 21% by the general public. Their biggest shareholder is Vanguard at 9%, BlackRock at 7%, Dodge & Cox at 2%, Fidelity at 1.75%, JP Morgan under 1%, Goldman 0.6%. They do employ a lot of people, 169,000 in 2013. Its highest was almost 300,000 in 2018. At the end of 2022, it's 259,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, Santiago, the Bern, London Stock Exchange, Euro TLX, Wiener Börse, Lima Bolsa, Bulgaria, BATS Europe, Sao Paulo Bolsa, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.